start. ये नजर तो नहीं आ रहा? Good morning, class. This is your instructor. My name is Maliha Beg. I'm going to be talking about principles of accounting today. So before we study the principles, I'm going to be discussing what is accounting, why we need accounting, and what is the purpose behind developing this subject. So accounting, as you can see, it deals with money, right? Any monetary transaction measured in economic terms, and to measure the economic performance, whether of the country or of the companies, is all dealt with in accounting. So I'm going to be talking about the definition first. So there are components of the definition, and the definition is that accounting is the art. Accounting is the art of recording. So it's just starting with the measurement, okay? So it's recording, then classifying, and summarizing financial information or financial transactions. As you can see, there are components now. In this, first of all, it's an art, right? Some people can argue that it is science. So you can study that it is, in scientific terms, but there is the concept which is pertaining to art, because science is related with facts, and we do study facts. However, we need to ascertain those facts. So we need to ascertain or find out. So I'm using this word ascertain, and ascertain means to confirm and to find out. So in this case, we are going to find out whether the fact is true or not, that a particular information, which is the financial information or information related to money, and that information is correct or not. And in this case, if we are able to confirm that this particular information is correct, then it becomes a fact. And when we study facts, then we can say that, okay, this is to some category social science, because we are not doing any kind of experiments in that, and there is no concept to prove whether this notion exists or not, because see, they are given it has some quantitative measurement involved, so it is not entirely related with the labs or conducting scientific experiments or dealing with any form of proving of results. So since we are not proving anything, and we don't have anyone to prove except that we have to confirm certain numerical information, then we use the word art, because art can be defined not specifically but in general terms. And we are dealing with monetary values here, so we can use the word art. And there are other, you can say, avenues where we can have some flexibility in defining and studying accounting. For science, it is just fact, and we have to, as opposed to having people propose theories and then go on proving whether those theories are correct or not. So we don't have such proving process here, so we cannot exactly say that this is a science, right? But we can categorize it as social science. Now, accounting, as per the definition I have already stated, it has a number of constituents. So I'm going to be talking about the constituents now. First is an art, and loosely defined as social science because it has social impact, and is the art of recording and measuring. So you record, if you don't see it correctly, I'm just going to make it a little bigger in font. Recording, okay, and this is, you measure something and you record it. How we record it will be our next focus. So first is that we are dealing with how to record any financial information, any financial transaction. I give you 100 rupees or $100 in this case. So this $100 is something that you will record in some copy on a piece of paper or in your notebook. So this 100 is your record now. So you're going to record it first, and then this is to classify. This is classification, and I'm going to write it as classification. I hope that you can see it. Classification is that you are going to be making several accounts now, and then you're going to decide in which group, in which category, and in which title under which you're going to place that thing. So it is whether this title is correct or not is the portion where classification is dealing with that process, okay? And recording is that, first of all, the thing has to take place. So I gave you $100, now you recorded it as you received. So this classification would mean that now you are, let's say, Sam, and I am, let's say, okay, just say A, and I gave you $100, right? So in this case, you will write that, okay, A has given you $100 and you have an account, and this account under which you are going to just place that on this date. Okay, so now you place it like on, let's suppose, 1st of, today is, let's say, 21st of September. You got $100. So now your name is written here, and with that name you have the amount. Okay, so that means that you are going to classify yourself as one of the receivers of money, and I am the one who paid you. So I am the payer in this case. So Payer, I'm the payer, and you are the payee. Okay, so or you are the receiver in this case, and you can also record it as receiver, right? So you are the receiver of money, and I am the payer in this case. Now this is known as recording under a classification Sam, that you received it and I gave this on this date. So this is classification. So basically you define the title under which to place the particular transaction in, right? And there are different classifications, there are different accounts. I'm going to be giving examples of different accounts as we proceed further on in the lecture, okay? Now the third part, which is very essential, is summarizing the information, okay? So we have summarizing. Now what is summarization, okay? So once you record something, you're going to classify it under which to place, and then to summarize means that now you have many transactions going on in that period. So on 21st you had $100. On 25th, maybe you paid someone $50 out of it, right? So now you paid B $50 on, let's say, 25th of September, and you paid B $50. Now you're going to be recording it. Now you become the payee, payer in this case, sorry. You become the payer, and B would become the payee. Okay. Either you put it in his bank account or you give him straight off cash. So first of all, you're going to be defining who to give cash to, and then you open this, or you make one account by the name of Sam and you write from whom you got the money and to whom you disbursed the money. And now, of course, now you had $100, out of which you paid $50, and the remaining $50 are still left with you. So this is basically now, so now this is the balance, okay? So this is known as balance. And this balance is brought forward. So there's a terminology by the name of brought forward or carry forward, okay? We're going to be discussing the difference between brought forward and carry forward as we proceed further on with the lectures, but at this time, you just need to know that we bring something forward means that you're going to carry this balance ahead. Then we are going to be, if adjusting entries are made or if other transactions take place during that particular month, we're going to be making some adjustments. So if, for instance, someone gives you more money or you pay someone, so you're going to be taking this balance into account and then proceeding with further action on this. So now if I say, you received from C, I suppose, $20. So now you're going to be taking account whatever was brought forward. So first of all, it was carried and then it was brought forward. Okay, so there's two things. This is carrying something and then bringing it forward to impact upon the next transaction. It's going to be the next financial transaction. In this case, it becomes $70. So now you can see that again you become the pay. So your role as a payer and pay, they keep alternating, right? Now this is done throughout the year. Month-wise you can divide and then you can proceed with, collection of all the transactions of the entire month. So there are 12 months, 1, 2, up to 12. So in each month you had some balance that was brought forward. And once those balances are, settled eventually at the end of that 12th month, this is known as the year end, okay? And this year end is also closed into one final form or one final amount. So for instance, this was the last period now, or the last transaction of the year, and no further transaction took place in other months or subsequent months. So I can say that at the end of the 12th month, this was the balance for Sam. Now, so you're going to be classifying. So to classify, you're going to be classifying Sam and writing under it as $70. Okay, this is the final amount. This is known as final amount, under which you're going to be placing $70. This amount is as a result of several transactions occurring during the year. Similarly, not just about you, but the business. When you talk about business, right, there are different transactions of different nature. Okay, so by nature I mean that, okay, one person is giving you money, then you give to someone else and you take a loan from bank, right? So it becomes your bank account. Now that will have a different nature, and you give cash from your own. Maybe you save some money, that will be having a different nature. So it's going to be cash in hand or cash at bank. So now you're going to be debiting or crediting. That is a concept again we're going to be dealing with further in the lectures. But at the moment, let's say you bought something for your own self. You bought a car for yourself, right? And then you make some expenses on that car. So now you make another account by the name of car account. Now because it's not you, it's your car. So you can say that, okay, this is the car account, but this is, or you can name it as the halves, okay? The halves means basically it's something that you already have. And there's a terminology that we use for these things. which actually bring you value or worth, which is not a person. So for instance, this car, and you got this car on, let's say, 1st September for, let's say, $20,000. And then you made expenses on that car, so now those, okay, so now you're making some expenses on it or whatever, then you sell this car for, let's say, $15,000. Now, why have I written it like this? Because I want to make a demarcation between when I receive something and when I, get rid of that thing or give it out. So if I receive something, it was on one date, and if I give it out, it was on some other date. So I'm going to be making a, first of all, demarcation between when something goes out and when something was with me, right? And then it was on another date, so let's say I gave that on 31st of December. Now that is year end. Now for instance, I gave the car next year, but then that entry would not be reported. Anything which is of that particular year, so if it is 2019, all the transactions pertaining to 2019 would be coming under recording, classification, and summarization process. If the year proceeds on further, we go forward to the next year, then whatever transactions took place till 31st of December, only those transactions would be coming under the summarization process, and then all the transactions pertaining to this account would be recorded under the car account or the have account, whatever that you had at that time. So we are going to replace this name with something else as we proceed on, but at the moment that you need to understand whatever we have as a non-human thing, or I'm a person, so it's a non-person, or something which is not personified, then we are going to make a different account for that. So we have a business, and accounting is basically done for business. So I'm going to rub this off now. You can understand, first of all, why we say that it's an art. Because we have different transactions and we have to confirm those transactions. There's nothing to prove in that. It is just a financial summary of all the measurements in economic terms. Then we are going to be talking about the information for decision making, but know that accounting basically deals with the financial transaction, they're recording, they're classifying, and then summarization process where we make clusters of information and we put them under a particular title and group according to the nature of the financial transaction. We're done there. Now we come to accounting information for decision making. Why we do accounting? Because businesses require accounting. Now, which kind of businesses? So these are all companies, all even in a household, you can see that a person, a father, will make a budget. The accounting starts from there. So you are a person who gets pocket money. Let's say $100 per week, or you can say maybe $1,000 a month, or just maybe $200 a week. So just according to whatever that you get. So this is your financial record. So now according to that record, you are going to be placing the information logically, strategically, and in a proper way. And there's a way we go about it to measure that information per person, and then that person grows into a household, and then household to country-wise, where we talk about the GDP, GNP. But for companies, we have the economic information pertaining to whatever they buy, they sell, they deal with in terms of trade, they trade in, or the business in which they sell their stuff. They sell their products, the commodities, to other people. So whoever they receive money from, that is recorded separately, and whoever they purchase the goods from, or they manufacture those goods themselves, So that is placed separately, okay? So then, now, why we need to have a separate subject for this purpose? The reason is because we need to decide whether we are progressing well or we are not progressing at all. So if we are running into losses, then we don't want to go ahead with that particular trade or transaction. We need to be sure whether what we have done up till now is, good for the business. So whatever business transactions are there, whatever the classification would be, is according to the nature of the products, the nature of the transaction, the financial transactions that we have. Now we are going to be talking about the decision-making process. So what kind of decision is required? So first of all, I'm going to be reading a bit of the stuff so you can understand the basic book language. So it's bookish stuff. Accounting as a language of business. So these are the learning objectives I require that, okay, now the book that I'm going to be teaching you is by William Hacker, Bettner and Carcello, and this is the 18th edition. So it's William and Hacker. These are all the last names or the first names. We just it's just mixed. Hacker, Bettner and Carcello. Now, there are 4 authors in this, and this is the 18th edition, and this is basically financial and managerial accounting, right? The book is Financial and Managerial Accounting. This is the 18th edition, and the chapter is first. This is the first chapter, and the name of this chapter is Accounting Information for Decision Making. Why we need the information? Because we want to decide something. So now these are the LOs. It means learning objectives. So LO1 is discuss accounting as the language of business. And the roles of accounting information, like I told you, it's very important, it's very crucial, it's pivotal for deciding on the future of the company, of the type of business that you want to do, and whether you want to go ahead with it in the future, and to predict certain things about the direction of the economy, as well as the the general mood of the business, I would say, because there are certain there's a climate for business. If you want to be doing that in a particular geographical environment, whether it's suitable for you. For instance, if you are in Canada, I would say, or in the United States, so whether you want to sell Asian stuff over there, like clothes, or you're going to be studying their environment. So this demand and supply would actually help you to ascertain. There are components, we are going to be talking about them later on, but this accounting information is dealing with the sale and purchase of your products. And there's a terminology that we use for it, but I'm going to be talking about the terminologies a bit ahead in the lecture. Now, the second learning objective is to discuss the significance of accounting systems. So we have an accounting cycle. By systems, there are checks and balances in place. And there are softwares, so don't confuse the word system with just softwares. So we have checks and balances, there are rules and regulations that we have to follow. So we have reliable accounting information. The purpose behind having rules is reliability. You have to learn this word, okay? Just ingrain that in your memory. It's reliable. Reliability, it means confirmability. It means that now whatever information is there is correct. So this is confirmation, in other words, that you have to rely on something. So reliance or reliability is that this information I could rely on. I could make decision based on this information. So this information, the source is reliable. And the source naturally is the company itself, and the other, there's evidence behind it. So reliability is because it has some evidence to prove the existence of that thing. So not the proof in the sense that we do it scientifically, but rather through checks and balances in place, through regulations that we have. So the other important thing is that we have rules in place. Then we have the importance of financial accounting information for external users. Okay, so these are external parties. By party, there is no party chilling out, it's not like that. It's just parties. For external parties, these are the external users. Now, what is external user? In a while, we just go to it. Primarily investors and creditors. What is that? Let's just move on ahead so that I can then just give you a brief intro about what these terms mean and connote. So this is characteristics of the information and the importance of internal parties. So now we have highlighted a number of things. First is reliability, confirmation. Then there is external and internal users of financial information by parties, something, a group that could be using it. And then we have the objectives and characteristics, and then there are also 5 components of internal control. Now this is a terminology, you don't have to immediately know about it. I'm just going to be telling you in easier terms. Internal control is the checks and balances in place, is the rules and regulations we talk about within the company's environment, the setup of the company, the businesses that have whatever procedures or processes in place to make sure that there's no hanky-panky done, okay? Because you've often heard that, enterprise, ran into losses, or the business entity. So we use the term business entity or the enterprise. How you spell entity? It's like this: anything which exists for a purpose, okay? So we have business entity is to do business. Enterprise, it's a financial entity. A business entity is a financial entity. And we have a number of things in place. Notice we have various LOs in this. I run this part and then you can see it. When we talk about accounting, we say that it's not an end, but it is the means to an end. Now, what is that end? It's just a summarization process. This is the end, but it is not the end because it is just serving you as, like a carrier would serve you. The financial information is placed in a particular fashion, in a particular order for the reader to understand it easily, just like you have a mathematical formula. So this formula is just means to serve you, but not as an end. It's not the financial, excuse me. Okay, so now we carry ahead with the assumptions and measurements. Now there are certain assumptions, means that we assume there's something that we take for granted, that these things have to be put in place so that we can move ahead with the process of true accounting. By accounting, usually, people take it as something just quite technical. However, as I've already given you an example of a household, so everyone will be using accounting for themselves, for making any decision. So why we use accounting is because we want to make or reach upon a decision, or we want to finalize something. And then we have to make certain assumptions, so we go for those assumptions like as we go about for the principles of accounting. But before that, there are certain terminologies and there are certain reasons that you need to understand. So there was a commission by the name of Pathways Commission, usually that is with the intervention of all the G7 countries. So we have that have described what is accounting. So we have businesses that are engaged in economic activities, and converting these into information, like we have already dealt with this part. Now, judgments are required again for effective critical thinking skills. Critical thinking is something that makes you think over what is the pros and what is the con, or what are the, what is the impact of that decision on people around you. So for instance, I say a company would start a project, or they would have to see, are there any environmental impacts? If there are environmental impacts, is there any cost to abate those? And then there's another company that would see whether the land that they want to procure does not belong to someone already. So there are different decisions that you have to take place, that you have to take into account. Now we have critical thinking, then whether there is any usefulness in that decision and what good decisions can we come up with that can have a prosperous impact on the society as a whole. But we're talking about really large scale level at that. We have some very big conglomerate. But at a small level, the company would rather think about itself as in the terms of progression, whether it would do well. And there is an assumption, since we're talking about assumption in this case, so assumption, one of the primary assumptions is that an enterprise has to be a going concern, okay? Note that assumption, when we talk about assumptions, one is that it has to be going concern. Since it was connected with critical decision making, this is one of the examples. So I laid out there are different assumptions, and we're going to be doing them slowly. This is the foremost in importance. Going concern is when an enterprise is assumed to be progressing well, not just for the current financial year, but in prospective or subsequent financial years or accounting periods. So when we talk about accounting period, it could differ slightly from the financial period, because usually the financial year would be from January to, let's say, December. But for some companies, it could go from June to June. So the accounting year or the financial year in terms of accounting could vary from the traditional sense of the word, okay? Now, the going is that the enterprise is assumed to be a going concern. This is not the concern that you read about in English language. That concern would be something that you are, worried about. This means entity. So going entity or going concern in this case is a company which is assumed to be running smoothly its functions, its financial operations in subsequent accounting periods. Because if the company is running into losses, it is no more going concern. So this is an exercise into effective critical thinking skills. I want to make my company run smoothly for future times. So in that case, I need to think about its future. If I make something which is for short term, then that would be a project. It's not going to be a business. So that is the difference between a business. So if I say that it's, let's suppose, a public listed company. At the moment, just remember the word public listed, because you might not be clear about what it is. So public listed means that it is a company that is largely owned by many people. And it has an unlimited life, okay? Then corporation in this case has an unlimited life. So it is assumed to be a going concern. But then there are big companies which run into losses and they cannot take care of their employees, the management, or the people that are working for it, and they cannot take care of the customers as well, because whatever that they initially, had decided to do, or they had projected that they would be able to do, they have not been able to do that, either because they're running into losses because of lack of sales, or the commitment failed, or there was corruption, whatever the reason is. But if it runs into losses, then there was some context of effective critical thinking missing in that, right? Now we go for the internal external users, and I have also a PowerPoint slide that we would be doing recap with. Now, as you can see this diagram, I hope you can see, I'm just going to enlarge this slightly. So I hope you can see this now. I'm going to be rubbing whatever I've written on. Okay, now, so we were talking about effectiveness of decisions. This effectiveness is based on good decisions, and there's useful information. So starting from economic activity, like I said, we have a business entity, an enterprise with economic measurements going on. So there's an economic activity, first of all. That's a condition, and under which the business can take place. So we have shades of gray here. Now it means that probably there are some periods where creativity process is not very clear, but the activity nevertheless is going on. Could be high times, could be low times. Then we have accounting judgments according to whatever is the low time or where excessive critical thinking is required. Then we do judgment. So this is accounting judgment, whether to go ahead with a particular deal, whether we should buy something. So if in this institution I'm teaching you, so in my university, we are going to be making a new building, or opening a new premises for teaching. So this is a decision-making process which is quite critical, it's quite important. So if I make a false choice and students don't come in, so I'm going to be running into losses. So in that case, my judgment was flawed. So we have accounting judgment, which requires critical thinking. And then we have useful information according to that judgment because we note it down. We affix our judgments in writing. And then there's a way in which we write those judgments because we are going to be recording it in forms of or in financial terms. And then there are formats. So we do that in one or two lectures. After one or two lectures, we're going to be talking about this essentially how we make the formats. So we have judgments, and then we have useful information, and then we have good decisions. Now, good decisions are basically a filter of the bad decisions. So if you learn something in the process, then you can just simply undo that decision. Sometimes we are able to spot some trouble or problematic areas or loopholes in the beginning, and then we do the spotting at the later part of our decision-making process. That's going to be an ill-fated thing for the organization as such. So we have attributes for good decision-making. Okay, so now, first of all, there's also something which is very important, and the question might pop up in your mind. So who checks these? Who makes these rules? So first of all, for accounting for United States and Canada, which is known as the North American region, we have the GAAP, which is the Generally Accepted Accounting Principles. Okay, and there's an American Association of Chartered Public Accountants. Okay, so this is an American institute which is known as AICPA, AICPA. And there's governing bodies, and we have research institutions that are linked with that, and they have the GAAP, which is the Generally Accepted Accounting Principles, under which they would be, whatever accounting information is following those rules and regulations. This American Institute of Chartered Public Accountants. And we have for the European region, for Asian region, then we have International Accounting Standards Board and the CA for the Chartered Accountants. For UK's ICAEW, which is the Institute of Chartered Accountants for England and Wales. And we have International Accounting Standards Board, which is IASB in this case. And we have the Chartered Accountants. This is the equivalent of a CPA. So the designation is known as CPA. The institute is AICPA. And we have ICAEW for CA for UK. And generally in Europe, this is the terminology. The CPA is equivalent to a CA. And in Pakistan, we have ICAP, which is the Institute of Chartered Accountants of Pakistan. And the designation is CA, which is comparable to that of CPA. But we have to give, obviously, certain papers, examinations they are conducted for ICAEW, I guess 2 to 3 advanced papers that you have to give in the UK. But the rest can be covered in the ACCA examination regime. So these are the terminologies, these are the boards. This is International Accounting Standards Board. And the AICPA, basically whatever rules and regulations that AICPA makes are under GAAP, which is the Generally Accepted Accounting Principles. And whatever rules IASB makes are under IFRS or IASB. So this is IASs. First of all, there were IASs. So there are two things. First was International Accounting Standards. Then came the IFRS, which is International Financial Reporting Standards, and there was an International Financial Reporting, this is IFRIX, known as the Institute or Council. So this was International Financial Reporting Institute or Council. This institute would be giving or issuing IFRSs, right? And these were required after ISS were made. Since we are not going too much into financial reporting at the moment, you should just know that there are rules and regulations in place, there are bodies in place, they are governed by those bodies, and then further research is being done. And how this research is done is that those researchers would be sitting in those boards and they would be discussing the pros and cons for introducing a particular rule, just like any rule is in place. Let's say a rule is in place that you can't, cross the red light, so it's just similar rules. And then they're documented in a book. These are the reporting standards book. And then there's an interpretation of those accounting or reporting standards. So now we have organizations that are looking, they have this whole institute intact, which will be, looking at over all these activities. They're going to be monitoring and supervising all these economic activities. Okay, here's an example. Just trying to make it a bit interesting for you people. There are a number of things that you have to note down. In Sony Corporation, in 2015 financial statements, okay. So this terminology again means that there are books of accounts. Books of accounts means that there are certain books, or just like you have a notebook, so we have reports, or you have to prepare reports, registers, or whatever that at this time you can just simply understand this is a more official version of the notes that you make for financial transactions. So to owners, financial position is presented as consisting of 15,834 trillion in assets. Now, if you remember a while ago, I mentioned the word haves when I was writing the word car. Now, haves is basically assets. Okay? So this terminology, you should know assets. Asset is an English word. Asset means that whatever that you have of value. And there's a definition of asset is that a thing which would have an economic value, and without getting spent or spent itself, without getting spent itself, it would be useful for giving you things of value. It would give you further benefit without being consumed. So we use the word consumed. It means that it will be giving you a thing of value. I can give you an example of a factory. It has a machinery in place where it produces things. So that machinery is producing something. Now that machinery is a thing of value. Now, car exactly is not an asset, because that's why I was not writing the word asset at that time, because I was giving you an example of a personal car. So we have a business model, and we have various other things. Car can be an asset if you use it for things other than your own personal consumption. So if you, suppose, have a rent-a-car business, you can give the car and make money out of it. So to the person who will be using it, and then returning it back to you and give you money for that. So this is how you use it as a product, as an inventory. The word I will use for product is inventory. And this word is asset. Now, asset gives you inventory. It has a useful life, but that useful life would be, a long useful life. It could be 10 years, 15 years, that would be defined by rules and regulations. By rules and regulations, I mean the accounting rules and regulations. For each asset is defined separately. For 10 years, could be car. For hire, just like you have daily service, that's their asset. Now, because it is used, so inventory, sometimes we have inventory, but it's a service sector, we usually have people as opposed to an inventory. So now, there's a difference between an inventory and an asset in this case would be that asset would not get consumed, whereas an inventory gets consumed. So for a vehicle business like Daewoo or some other like Greyhound in America, it's convenient for you, those have drivers in it. So they have employees that are operating this asset. But that asset is not, is this just covering the distance? So in that case, they are not having any inventory. But it is directly used, and the service that you take from that asset is as an equivalent of inventory. The service is that you have to travel distance from one place to another. It takes you to a driver, and he's an employee, by the way. So inventory would be in a factory where it produces goods with the help of the factory. So the machines are employed to, churn something out, like the parade chips, or maybe some other, like hot dogs factory, or steel mill. Could be anything where they make some things in inventory because it gets consumed, but an asset does not consume. It gets it gets depreciated rather. Depreciation is another term that you have to learn. Better to learn it right now. Depreciation. We're going to be doing a number of terms, but first of all, you have to learn what is inventory, what is asset, what is depreciation, what is critical thinking, what is external user and internal user. Okay, so we just go with that. What is external and internal in a while, in a bit. So depreciation is something which is known as wear and tear. It is wear and tear. So it can get depreciated or wear out. In other words, so this is an asset that will wear out eventually, but it does not get consumed. By consume, you mean, like potato chips factory. So you eat the chips, so you consume them, right? But the factory can't really eat the stuff, right? So it can have expenses, it can have repairs, it can get damaged. You might ask. So for damages, there is another term we use which is known as expense. With assets, we incur expenses. When assets get consumed or depreciated, okay, they don't get consumed in the traditional sense in which we use the word inventory. They give you inventory, they give you an economic, they are value, and they give you things of value in future financial periods, and when they get worn out, that means they're partially consumed. In that case, we have expenses, and that's another account, another classification. Okay, so now then we have assets. Cash is also an asset. You might ask, no, it's not producing something, but you can use cash to buy something, but you don't get, you can't just consume. The moment it gets consumed, it becomes an expense. Asset does not get consumed, first of all, in the traditional sense of the word. It gets depreciated. If it gets depreciated, that's an expense, because now it's getting worn out through use. Now that is an asset when we talk about machinery or plant. This is factory, okay? So asset example is a plant as in factory, or equipment that you use, or machinery that you use. Machinery. So we have plant, factory, equipment, machinery, property. All these things. Then we have depreciation. But remember, for property, the premises, the word in accounting that you come to terms with is, or encounter this word, premise, premises. Now by premises, you can have a plot, an empty plot of land. That does not get depreciated, okay? That does not get worn out. We have maybe a building, a structure on that. So that structure can actually get disheveled eventually. And that would be in the process of wear and tear. Now we have assets, and they present those assets in a record, in a financial record, financial statements. And machinery and equipment with obligations against those assets, obligations. This is the terms. Now you are to highlight these terms. So we have assets. Cash equivalents means something you can purchase from cash. And then we have sleeves. Okay, so now they had obligations and they had the assets. So we had this 15,834 trillion yens, and then we have obligations of 2,000. Remember that an obligation is something that you have to pay to someone. Like I was a payer, so I gave you $100, right? So paying you was my obligation. Obligation is an English word again. It means that you're bound to pay someone some money because you owe them that money. And the term that an accounting that we use is liability. Liability. Okay. Liability means that, again, there's an obligation to pay something. When businesses have liability, it means that they are supposed to pay loans back. When you take loans, then there's an obligation created automatically. And then we have the interest on that. You take loan, you pay interest. So now this leaves 2,928 trillion because out of the 15,834, there were obligations of 12,906, and then that left 2,928 trillion as the owner's interest in those assets. Okay? And then the same results. Then there was a net loss because you have to pay interest. Now you might ask that assets, how could assets have interest? Because assets are growing in business organizations when they take loans from banks to develop that asset. And in the next lecture I can discuss about how to create public listed companies and how to create obligation in that sense of the word. So you are to study this. Now we go ahead with managerial accounting is when decisions are taken. Okay. There are two things, first of all, internal users and external users of information. Internal users and external users. At the moment, you are to just understand that internal user is someone who is running the company. He is the owner, the CEO, running on behalf of the company's owner is the CEO, the president of the company. The employees could be internal users because it would matter to them where they're working, right? External users could be creditors. So now there's a PowerPoint for you to see, okay? So just summarize this entire chapter in this, and also if you can just see this, or I can just, in this case, we have, I have enlarged this. Now you can see users, right? Who uses the accounting information? Just remember that slides will be uploaded in the LMS. So you have investors, the creditors, the people who pay you money, they loan out their funds to you. These are the banks. The investors, you are the business starter, so you are the investor. The managers, the ones who are managing the company, the owners. The customers, because you're buying their products. And then there's the employees. Regulators, because they want to see whether the company is doing good or not, because that company is jointly owned by a number of owners. How does that happen? We do that in the next lecture. So we have SEC, which is the Security Exchange Commission. Remember these terms. There's IRS, which is the Inland Revenue Services, and then there's the Financial, Trade Commission, or there are other, commissions that are as regulators that can see whether the financial transactions are being reported correctly or not. Then we have the information as cash flows, profitability, and financial position. All these have been already discussed. Cash flows, basically, again, we do that in later chapters, but just to see whether the cash is coming in or going out of the business. And then we have performance evaluations through different methods in place, whether the company is doing good or not. And lending, borrowing, resource allocation, where to put, like if I have to open a premise, I have to arrange money for that. So where to put funds, tax strategies, and we have stock investments. Okay, I would end my lecture here, and thank you so much. I hope that you learned something from today and from today's lecture, and kindly just do this chapter, at least initial half, and then the PowerPoint slides. Thank you so much.